Hello everyone, welcome back. Before we jump into the markets and charts and the macro talk, let's just take a moment to check in. How's your day going, guys? And yeah, seriously, I mean it. How are you? Did you get a chance to rest today? Did something good happen? Or was it one of those busy days? Non-stop days where time disappears and suddenly it's nighttime again. I know many of you tune in after work, after school, after taking care of your family, or even during quick break. So I just want to say I appreciate you being here. And I'm curious, what do you guys do outside of trading? What hobbies do you enjoy? Gym, running, gaming, or even cooking or reading? Or maybe you're something into niche like gardening, restoring old tech, photography, or anyone into building Legos? I'm really into I'm really into making puzzles. Mm, for me, I always remind myself to stay balanced. Markets are important, but they're not everything. Sometimes the best thing you do for your trading is to step away, refresh your mind, and do something you genuinely enjoy. So, as we settle in for today's session, take a moment to relax, take a big breath, breathe in, breathe out, grab a drink, get more comfortable, and breathe a little. Let me know how your good day is going, guys. All right, once you're settled in, we'll dive right in. Today, we're going to talk about something quite important, the outlook for US Treasuries and what 2025 and 2026 might really look like. But don't worry, we'll take it slow and make it easy to understand. This isn't going to be one of those stressful, fast-talking market updates. Think of this as us hanging out, catching up, and then looking at the bigger picture together. All right, ready? Type ready in the comments if you're ready. Let's get into it. So, how do we interpret the Fed rate cut and key levels to watch, market structure, and the CTA flows update? So, I'm pretty sure everyone has seen the big news. So, today is Thursday, December 11th. Let's get through the latest views on the stock market. All right, let's kick things off with something everyone's been talking about, CTA levels. Do you know why CTA matters to the stock market? Anyone knows? Why? Because the CTA models buy when markets break above certain levels and sell when the market falls below certain levels. These levels are sometimes called trigger levels, momentum thresholds, or defensive lines. One moment, I'll write it for you so you can screenshot for your further use. So, CTA levels, you can call them trigger levels. Trigger trigger levels, or you can even call them defensive lines. So why this is important is because CTA models buy when and sell when so CTA models buy when markets break above certain levels and sell when market falls below. It's often referred to as trigger levels, momentum threshold, and defensive lines. So when price hits these levels, CTAs can create like big force buying if the level breaks upward, and it can also create big force selling if the price breaks downward. This is why Goldman Sachs, JP Morgan, Nomura, etc. publishes daily CTA models. Traders want to know where large quant flows may kick in. So now, Goldman just updated their numbers. And interestingly, the three key levels they highlight for the S&P 500 are 6,754, this level, 6,754, 6,512, and 6,020. These are the key levels that they highlighted. And they line up perfectly with the three defensive lines on our chart. It's always nice when independent models and price structures point to the same zones. It tells you the market isn't drifting blindly. The flows are real. 1, 2, 3. So, now if we dig into the short-term flow data, all three levels are still showing net inflows. What does this mean in plain language? It means every time the market wanders near these lines, we are seeing CTA buy flow stepping in, almost like invisible hands catching the market before it slips too far. So what I mean by this, oops, that's a bit. Every time CTA hits this line, we go up. Every time it hits here, we go up. And what we're potentially seeing is another upward. So this doesn't guarantee the market will straight go up, but it does tell us that downside has layers of mechanical support. Yesterday's session gave us a small clue. The market failed to close above the day's high. That tells me buyers weren't fully committed, at least not yet. So for now, we're still sticking with a range-bound back and forth outlook. Nothing wrong with that. Ranges give us traders plenty of opportunities, just not the buy and relax type of opportunities. So what should be your short-term focus? What we're watching next is very simple. Will the index pull back to the red support line? That's the spot where the risk-reward gets interesting again. A clean retest there gives buyers a textbook setup. If we don't retest, then we wait for momentum to tell us the story. So, but for long-term investors, honestly, if you're thinking in years rather than days, this is a period to trade less, observe more, and keep your emotional capital intact. Don't get sucked into every dip and pop. Patience is profit when the structure is undecided. However, for short-term traders, your playbook is tighter. Either wait for a pullback to the red line, where risk is defined, or wait for a solid breakout above the green line, with a full candle closing above. Wait for a full candle closing. No guessing, no gambling. Let price show its hand first. Do you guys agree? Meanwhile, let's see this. Stocks surge after Federal Reserve cut interest rates. S&P 500 just misses new record closing. So, blue chip Dow Jones Industrial Average benchmark S&P 500 and tech-heavy Nasdaq closed up a respective 1.1%, 0.7%, and 0.3% after Fed cut its key rate to average 3.5 to 3.75, which financial markets expected with a 90% likelihood. As I mentioned in our previous stream, people were expecting this. So the S&P 5 missed setting a new all-time closing high by fewer than 5 points, while the Dow was within 200 points of its own after edging near 500 points. So now, alright, let's move on to a few tickers everyone has been spamming my inbox about. These are the names that always get the most attention, so let's break them down properly. Nevada. Everyone wants to know if the dip, the breakout, or the moment. But if you actually look at the price action, it's telling you a much simpler story. We're still in that choppy, back and forth consolidation zone. A clean breakout from here is not likely in the immediate term. This is the kind of setup where the stock needs time. Time to digest, time to reload, time to shake out impatient traders. Sorry. So, think of it as Nvidia taking a long breath rather than sprinting. If you're planning to buy Nvidia, just wait, let the structure finish forming. You're not missing out on anything yet. If you're already holding, now's the moment to ask yourself whether your time cost is worth it. This isn't a quick swing, it's a slow build. I'm gonna open for you guys this one. I wanna look at this one. Now let's look at Oracle. This one is rough. Oracle stock is plunging despite new comments from Nvidia and Meta. Here's why. So Oracle has had some new deals with big AI names. That news wasn't enough to keep its stock from plummeting late Wednesday after the company released its quarterly results. This giant said that new agreements with AI chipmaker Nvidia and Meta Platforms helped drive its backlog to a record $523 billion. However, their second quarter's revenue of $16.06 billion, while it's up from 14% from the year period, came in below analyst expectations. Often better than expected adjustment earning of 2.26 per share. So due to they release their reports, they're forecasting a 19% to 21% revenue growth. So I think after the news release, people did not really care. Let's see. I mean, they cared, but not in the way it was expected. So the stock absolutely dumped in the pre-market around, here it was minus 12%. However, we're looking at minus 13.7% now. And that's just not a number. That's a sentiment bomb for the entire tech sector. Oracle's earnings basically dragged one of the big, uncomfortable questions back onto the stage. Can massive AI infrastructure spending actually produce returns? This is the same storyline that triggers the big volatility waves in November. And here we are again. Given the size of the pre-market drop, there's a very high chance the stock will print fresh lows today. But I really want to emphasize this. New lows are not viable lows. A lot of traders love the idea of catching the dip. But what they actually catch is mid-air, not the real bottom. Why? Because in a true downtrend, there is no such thing as the lowest. There's only lower. So, when can you bottom fish? Only when the price has fully reversed. Not halfway, not maybe, not looks cheap, a proper reversal. Structure, momentum, confirmation. The goal is never to buy the absolute bottom or sell the absolute top. The goal is to buy at the most confirmed point and sell at the most confirmed point. And keep your trader on. Oracle's sentiment shock may spill over into other names that have heavy AI infrastructure investments. Leverage or stretch valuations, especially within the AI core tech group. So a quick plug for those tracking the Max 7. If your main focus is the Max 7 or you want deeper dives into the big tech names that actually move the market, you're welcome to join my trading notes and weekly review core group. This is where I post more detailed breakdowns and updated trading plans. So let's get into the market deep dive. There's two big questions after the Fed rate cut. So let's zoom out for a moment and talk about the bigger picture. Because after every Fed meeting, the same two questions pop up everywhere. And this meeting was no different. In fact, it was even messier than usual. So let's break it down properly. The Fed rate cuts. Why did the US equities still drop after hours? A lot of people were scratching their heads late last night asking, wait, the Fed finally cut? Shouldn't the market be celebrating? Why did stocks sell off? Well, welcome to the world of buying the rumor and selling the news. It's one of the oldest patterns in finance, and it's alive and well. Let me back it with actual data, not vibes. So, historical statistics. Since 1985 till now, whenever the Fed starts cutting while the market is sitting near all-time highs, meaning within the roughly 1%, the short-term performance is meh. So, chances of stocks rising the next day is 56%. Chances of the stock rising the next week is 44%. And chances of rising 1 month later is 50%. So basically a coin flip or even worse. But here's where it gets spicy. Long term, it's completely different story. Once the first rate cut happens, the 1-year forward return for the S&P 500 is almost 100% positive, with an average gain of around 15%. That's not a small number, that's a full year trend. Do you know what this tells us? For short term, expect noise. You're supposed to feel confused, and that's normal. But for long term, history says buying the dip works, and it has worked for nearly 40 years. This doesn't mean you buy blindly. It means the short-term wobble shouldn't surprise anyone. So, the second question on everyone's mind that I was talking about yesterday. Do you think the Fed meeting was dovish or hawkish? Now this is where things get even more interesting, because this meeting wasn't clearly dovish or hawkish. It was a weird mix, like someone ordered a dovish burger but the Fed sprinkled a little hawkish seasoning on top. If I had to summarize it in one sentence, the Fed injected more liquidity than expected, but completely disagreed internally on rate cuts for 2026. Let's unpack that now. Liquidity boost exceeded the expectations of many, which is a clearly dovish move. The Fed announced 40 billion USD per month in short-term treasury purchases. The market was prepared for maybe around 30 max. So this was a genuine upside surprise. Call it RMP, call it QE little, call it not QE but feels like QE, doesn't matter. The goal is the same: prevent liquidity from tightening. So, what is the catch? This liquidity doesn't instantly flood the system. It usually takes 1 to 2 months before the market feels it. Number 2, the internal Fed views on the rate cuts were deeply divided. That's a hawkish signal. The vote split was 9-3, one of the most divided since the 1980s. And they call this primitive, meaning they weren't forced to cut by data, they chose to cut early as a precaution. Even though they upgraded GDP expectation, they did not increase their rate cut projection for next year. So, the median still points to 1 to 2 cuts in 2026. This is the part the market that didn't like. But, ironically, this kind of disagreement also gives the market more room to speculate on future cuts. Because whenever there's division, there's optionality. Number 3, inflation is no longer the Fed's main obstacle. So this is a dovish setup for next year. The Fed acknowledged progress in non-tariff inflation, and service sector inflation continues to cool down. So, what does this translate to? Do you know? If inflation stops being the Fed's excuse, rate cuts become easier. This quietly paves the path for more dovish turns next year, which the market will eventually price in. So, number 4, So SLR relief incoming, another major dovish factor. So what is SLR? It's the supplementary leverage ratio. So this relief is expected to kick in around April of next year. This primarily helps banks take on more treasuries, which should push down the long-term yields. And it should improve overall market liquidity. So, combined with the balance sheet expansion, it tells us liquidity-wise, the worst phase may already be behind us. That doesn't mean straight up from here, but it means we're likely past the tightest part of the funnel. So, what is the outlook for US Treasuries and the 2026 market path? So, everyone really wants to know, what does the bond market go from here? And what's the roadmap for 2026? These next few months are going to be very different from what we've seen this year. So let's walk through it carefully. So what is the long duration of the US Treasuries? Still waiting for the real trigger? My stance hasn't changed at all. The best time to go meaningfully long on duration isn't before a recession, it's during one. Right now, we're in this awkward middle zone where growth is slowing but not consolidating, inflation is cooling but not dead, and the Fed is easing but not anonymous. Liquidity is improving but unevenly. That combination creates volatility, but not a clean directional trend for long bonds. So for now, long duration treasuries are still stuck in this ping pong range, and until the economy hits a real contradictory phase, the big trend hasn't arrived yet. As you can see, same thing. We're still in the ping pong range. If you wait for that powerful multi-month bond rally, that tends to only happen once recession signals become undeniable. So we're not there yet. So the 2026 market playbook, the mid-year pivot is the story. Looking ahead, there's a major shift coming that most people aren't ready for. It's the Fed's influence will gradually fade, not because they're irrelevant, but because the market will begin pricing in the next Fed chair as early as the quarter one. So the momentum the market thinks the new chair is more dovish, sentiment can flip instantly. So let's break down next year into two halves because they feel very different. So the first half of 2026, the bullish window. The ingredients for first half are already in place. Liquidity is recovering with QE light operation and SLR relief coming. Liquidity backdrop improves steadily. Number two, speculations around a dovish new chair. Markets love narrative and a fresh chair with a potential softer stance. So that's a narrative. Number three, ISM potentially climbing back above 50. If the manufacturing data recovers, even modestly, that alone gives the market another leg higher, or at least a story to chase. Put all this together, and you get a period where upside speculation can easily dominate even if the fundamentals aren't perfect. So, this is the window where the risk assets usually behave well, not because everything is great, but because everything looks like it might get better. So, for the second half of 2026, it's where it gets tricky. But the second half is completely different chapter. If the new chair comes in and starts cutting aggressively, the market may suddenly shift from yay, more cuts to wait. The Fed's independence is in danger. When that narrative shows up, market tends to wobble, not rally. And historically, anytime there's uncertainty around Fed leadership, political pressure, policy credibility, volatility changes. So, although 2026 looks optimistic on the surface, the actual path may be strengthen first, weakness later. Basically, the reverse of what we saw this year. So, where 2025 was pain first, relief later, 2026 could easily be relief first, cautious later. So, this is your final reminder. This is not autopilot market. It's where you decide where you want to step in and how you want to position yourself. Do you want to be behind, left behind, or think ahead? So, let's wrap up today's market breakdown. Here's the key takeaway. This is not a buy or go to sleep environment. We're entering a phase where liquidity, Fed leadership, transitions, and mid-year macro shifts will matter more than any single headline. For the first half of 2026, the Q1 conditions still lean supporting. Liquidity, recovery, potential ISM stabilization, and the market starting to price in a more dovish future Fed leadership. But the second half introduces more risk, especially if aggressive rate cuts raise concerns about the Fed's independence or if growth momentum weakens. For bonds, long-duration treasuries still make the most sense in an actual recession, not during pre-recession volatility. So, patience remains the most strategic position. Patience is the key. So for equities, stay disciplined around key index levels. They are your roadmap. Let the market show strength with confirmation or weakness with clear breakdowns. Don't anticipate. React with structure. And as always, protect your capital, stay flexible, and don't let narratives override the price action. That's the key takeaway of today's live. Do you have any questions? Let me know if you found anything interesting in today's live. And thank you so much for hanging out, watching the charts with me, sharing your thoughts in the chat. Whether you traded today or just observed the price action, I appreciate you spending your time here. Before we log off, let's quickly recap what we covered today. We walked through the key levels on major indices, looked at the strongest and weakest sectors, and we talked about how momentum shifts through sessions. We also broke down a few individual tickers that made big moves and looked at the technical structure behind those moves. Remember, everything we discussed today is for educational purposes. Nothing here is financial advice or recommend to buy or sell anything. Your capital, your risk, your decision. Always do your research. I really appreciate your engagement today. The questions were sharp, the analysis in the chart was on point, and the energy was great. This community keeps growing, and it's all because of viewers like you who show up, learn, discuss, and stay curious about the market. If you're new here, make sure you hit that like button, that subscribe button, and turn on your notifications so you don't miss the next live session. We've got more breakdowns coming, more pre-market prep, more technical analysis, and of course, more crazy market moments to react to together. If you want to rewatch any part of today's stream, the replay will be available shortly. Feel free to go back, take notes on the levels or setups we discussed, and if you have questions about the stream, drop them in the comments. I always go through them. So, for those who want to deeper breakdowns, I'll be posting shorter clips and chart insights through the week. So keep an eye on the channel. Lastly, take care of yourselves. Markets can be intense, fast, and emotional. It's important to step back, reset, and recharge. The market will be here tomorrow, next week, next month. Consistency and a calm mindset always beat burnout. Thank you again for being part of this community. It means a lot. Alright traders, That's it from me today. Wishing you a great rest of your day and a solid plan for whatever comes next in the markets. Stay safe, stay disciplined. I'll see you in the next live.